Good morning, sir.
Yeah, good morning. Well, welcome to today's class. So before we move to our next topic, so I want to round up on the last topic that we treated, which is on value-added tasks. So we are able to solve, we have only solved a single question. We still have one or two questions to be solved so that we have a better understanding of the topic. So we are going to look at question number 2, which is on the material on page 17 as shared on the platform. So question number 2. So the question goes thus: Samuel Peter Nigeria Limited during the year ended 30th September 2020 presented the following accounting information: turnover, purchases of finished goods for resale, rent, interest, maintenance of motor vehicle, motor van, salaries, profit. The answer required. Calculate the VAT payable under the 3 different methods. Then now to my question, I want to ask us, who can remind me again, what are the 3 methods of calculating VAT? We have 3 methods of calculating VAT. Who can remind us of those 3 methods again? Hello, I'm waiting for us. I want somebody to remind us of the 3 methods that we can use to calculate value-added tasks. Oh yeah, now. 3 methods of calculating value-added tasks. So that means we don't go through our notes. Yeah, we have an invoice, yes, thank you. We have invoice credits method. We have the subtraction method and what? The addition method. Those are the 3 methods. So thank you very much. So somebody has posted it on the Ola Tudun, Olajide. So thank you. So those are the 3 methods: invoice credit method, subtraction method, and what? Addition method. So they now say we should use the 3 formula. They also made mention to us, if you could recollect, that out of the 3 methods, the one adopted in Nigeria is what? The invoice credit method. But where the examiner specify any method, please kindly adopt that method for the examiner. But where the examiner just say calculate VAT, you have to what? Adopt what? The invoice credit method. So we are going to start with the first one, which is what? The invoice credit method. So we're going to use an Excel to as we always do, so that for better. So let me. Yeah. So we have the So as we all know, for any question, the first thing, you have the name of the taxpayer. It's very important. You start with the name. So we have what? Samuel Peter. Samuel Peter, Nigeria Limited. So we have to compute. So the requirement, computation of VAT for year ended 30th September 2010. So the first method we want to use using invoice credit method. Or this method can only be called credit method. Instead of putting that word invoice, they can also say credit method. And we know that under that method, you have to look at your output VAT minus your input VAT. So we look at our output VAT. So our output VAT, those are the VAT that arises as a result of what? Sales. So let us go back. Let us go to our question. So in the question, we have a turnover. So this turnover will give rise to what? Output VAT, 86,770,000. In the question, we are not told that whether this value is what? Inclusive or exclusive. And I told us where it is not stated, we assume VAT exclusive. So we are going to assume VAT exclusive for that. So in that case, our output VAT will be 7.5%, 7.5% multiplied by 86,770. What would that give us? Can somebody help us calculate it? 7.5% of 86,770. What does it give us? Let us press our calculator.
6,507,750.
8 million 5.
6 million.
Okay. Million.
507.
Call it one by one. Call it one by one.
65.
65.
07.
07.
750.
75. So that is the value for that. After that, we also, under our invoice credit method, we're also going to minus what? Our input VAT. Input VAT will be what? VAT that arises as a result of what? Purchases. And I told you that the purchases you are going to include in your, as part of the input VAT, will only be what? Direct revenue expenditure. Only direct revenue expenditure. So we have what? The first one, we have purchases of finished goods for resale. So this is what? So this is the goods they are going to sell. So it is direct. So that is their product. So that they are going to sell. So the purchases will be what? 53,920. So we are not told whether VAT inclusive. So we also assume VAT exclusive. So we have our purchases. We also have 7.5% of multiplied by the value, which is 53,920, 53,920. How much does that give us? Now press calculator now. 53,920 times. So that should give us 40,000. So which is the value. Then after that, from the information, from the question, after that, from the question, we have rent. The organization is not selling rent. So that is not what? That is not a direct what? Direct revenue expenditure. We also have interest. It is also not a direct revenue expenditure. Maintenance of motor vehicle. That is not their major activity. It's just what? An indirect revenue. So we also have salary. Salary is not direct. Then we have a profit. So profit is not liable to value added tax. So the only purchase is what? Is the direct revenue expenditure. So under the invoice credit method, our value added tax will be what? This value we have here minus this. So VAT. The amount of VAT will be 6,507,750, 507,750 minus 4,044,000. So that will give us 2,463,750, which is what? Which is the value of the value added tax. So that is what? Under what? The first method, which is what? Invoice credit method. Apart from the invoice credit method, after the invoice credit method, we have what? The subtraction method. So if we are using the subtraction method, I told you that under the subtraction method, you have to look at what? The total value of the turnover, less what? Less the purchases, the direct revenue, expenditure purchases. So that will, the difference between the two will give you what is called value added. So it is the value added. When you now get the value added, you now apply what? The VAT rate. So under the subtraction method, we have the turnover. We already know the amount of this turnover, so we can get it from there, which is 86,770. So we have it at 86. So I have it at 86,770. 1, 2, 3. Then we less what? Less purchases. Less purchases. We know that our purchases also from the is what? 53,9. Our purchases is 53,920 minus 53,920 and 23. So we should give also the resulting, the difference between these, we give us what is called what? Value added. It is not value added that we want to calculate. What we want to calculate is what? The value added tax. So you now apply what? The VAT will now be at 7.5%. So the VAT will now be at 7.5%. So the 7.5% of this value will give us what? This same answer of 24,637.50. And I told you, under normal circumstances, where you have the same information, the answer you arrive when you use what? The addition method, when you use the invoice credit method, will be the same when you use what? The subtraction method. So the answer will give you the same. So the last one is what? We have what? The addition method. So the addition method is a different ball game entirely. Under the addition method, I told you that what you have is that you have to look at, you add what? All the income generated by what? The factors of production. All the income generated by the various factors of production. So let us go back to our question. Under the question, we have what? Rent. Rent is so the factors of production we have what? Land, labor, capital, and entrepreneur. Rent is the reward for who? Is the reward for land. So you are going to what? Put rent as part of what? As part of the item to be liable to VAT. So then we have what? Rent. That is one reward from the factors of production, which is how much? 2220 and 23. After rent, another item we have from the question is what? We have what? After rent, we have what? Interest. Interest is also a reward for what? For another factors of production. So it's a reward for capital. So you also what? You also include interest. You have what? Interest is also a reward for capital. Interest. How much is the interest? We have it as well. 46,005,000. After interest, we have a maintenance of motor vehicle. It's also a reward for entrepreneur because it's the one that will carry out the maintenance. Maintenance of motor vehicle. Maintenance of motor vehicle. Reward for entrepreneur. How much is that? 1,800,000. Maintenance of motor vehicle. 1,860. We have it as 1,860. 1, 2, 3. Then after that, we have a salaries. That's the reward for labor. So salaries is the reward for labor. We also include that, which is what? 7.5 million. Then we now have what? Profit. Profit is the reward for what? Entrepreneur. It's also reward for entrepreneur. 2,750. So the addition of all these rewards, so we add up all this reward. Any value that any value that it give us is what we are going to add together to get to the addition method. So the total addition will give us what is called value added. So when we add everything together, so that will give us what is called value added. So it is this value added, we now apply what? The rate. So we now have VAT at 7.5%. So we should be what? So which should be that value, 18,935,000 multiplied by 7.5 divided by 100. So that will give us 1,412,0125. So the answer you are going to arrive at under here is not going to be the same. You are going to arrive at entirely a different answer. So as I told us, both the subtraction and addition method is not what adopted in Nigeria. Please let us take note of that. So that is what when you want how to calculate your value added tax using what the three methods of what of calculating value added tax. Using the three different. Then apart from this, you may also have a situation, a scenario whereby what we can have what inventories. You can have opening and closing inventory. When we have opening and closing inventory, we also need to what? To take note of that. I made mention of it last week that when there is opening and closing inventory, who can remind us what do I say we are going to do? When there is opening and closing inventory, how do we adjust it? When there is opening and closing inventory, what is the adjustment to be? How do we adjust it? Anybody to give us the answer? So I told us when there is opening and closing inventory, you are going to what? You add the opening inventory to your what? To your purchases and other direct cost figure. While you what? You less the closing inventory from where? Direct cost. So the resulting figure is what you are now going to what? Which is the cost of goods sold, is what you are going to apply what the value added tax on. So we also need to what to adopt to look at a question on that. So we are going to look at a question relating to that. So there is a question, that question related to May 2024, which is question, it's also the material question 4, May 2024. So we have the question as does, Avila Manufacturing Limited is a company that is engaged in the manufacture of different kinds of perfume, body, lotion, and other cosmetic products. The statement of profit or loss of the company for the year ended September 30, 2021 is as follows. We have the turnover, less cost of sales, gross profit, other income, less operating costs, operating expenses, interest and similar charges, profit before tax, taxation, profit after tax, dividend, retained profit for the year. Then you are provided with the following additional information. Turnover is made up of 54,350, export sales and what? Local sales. Turnover is divided into two. We have what? Both export and local. Cost of sales comprises opening inventory, VAT inclusive, closing inventory, VAT inclusive, purchases of raw material, freight charges, other direct material. That will give us the percentage. Then 3. The company purchased plant and machinery which cost 24,750. This amount was included in opening inventory, VAT inclusive. Value added tax and withholding tax remitted during the year amounted to 2,173,180 and 1,787,500 respectively. You are required to compute the net VAT payable by Avila Manufacturing Limited for the year. So we are asked to compute what VAT, the net VAT. This one is asking, look at that word, net VAT. Why would they put net there? That means the company must have paid certain amount ahead. So first of all, you need to get how much are they going to pay. Under here, you can see the examiner did not tell you any method. But as you already know, we are going to adopt the invoice. We are going to adopt the invoice credit method. So let us go to our Excel. So we have what? We have the Excel. So as we already know, first thing, the name of the company. We have Avila Manufacturing Limited. Requirement, computation of VAT for the year ended September 30, 2021. So we also analyze the information Based on what? Based on available data. So we are going to start with what? Output VAT. Output VAT is what? VAT as a result of what? Who can remind us? Output VAT is VAT as a result of what? Oh yeah, now. Output VAT is VAT as a result of what? Somebody should respond now. Output VAT is VAT as a result of what?
Sales.
Sales. Yeah, that is the VAT generated from sales. VAT collected from sales. So we have what? So in the question, we have what? So in the question given, look at the turnover, 206, 250. Under the notes, you have two categories of turnover, export and import. So my question now is, out of liable to VAT, out of these two turnover, both the export and local, which one is going to be liable to VAT? Or is it the total amount that will be liable to VAT? Oh yeah, now. I mentioned all these things last week now. Which of the sales will be liable to VAT? Is it the total sales, the local sales, or the export sales? Which one? Is it the total, the local, or the export?
The local.
The local, why? Can you tell us the reason? Why?
Goods that are exported out of the country, I think they are exempted.
Are exempted from VAT. Yeah, that's one reason. But the major reason is that what? Because in Nigeria, we adopt what is called a destination principle. We adopt a destination principle. That means anything that goes out of Nigeria is not going to be consumed in Nigeria. So it's not going to be liable to VAT. So only the local sales, which is what? 141,900 will be what? Will be liable to VAT. And for the local sale, we are not told whether it is what? VAT inclusive or exclusive. So we are not told whether it is inclusive or exclusive. So we assume what? VAT exclusive. So we are going to assume VAT exclusive. Then we have what? Output VAT. So our output VAT will be turnover, local sales, which will be, the value will be 7.5% of multiply by, so how much is the value? 141,900 million. So 141,900 give us the value for the what? For the so then that should give us a value of what? 10 million. 10,642,500. According to the information available. So after the output VAT, the next thing we have what? We have what? We now less our input VAT. Our input VAT is VAT as a result of what? Purchases. But under here, we are giving what? In this question, we are giving inventory. We are giving value of inventory. So, and I told you, when you have inventory, you have to adjust your purchases and direct cost figure against your inventory. In note 2, we are told that cost of sales comprises opening inventory, VAT inclusive. Look at it. The opening inventory was given to us as VAT inclusive. Closing inventory, VAT inclusive. When they now give us, they now say purchases of raw material, 94,600 million. This is supposed to be 94,600. Okay, the 1,000 is up here already. So it's the way the arrangement was scattered by the by the conversion. So 94,600. So this 94,600 million is what? The purchases. These purchases given to us, we are not told whether it's what? Inclusive or exclusive. So that means what? We are going to assume it is what? VAT exclusive. But the opening inventory given to us was given to us as what? VAT inclusive. While purchasing was given as what? VAT exclusive. So before we can adjust this opening inventory against what? The purchases figure and the other direct cost, we must what? Make sure that what? They are on the same level. That is, the opening inventory must also be what? At what? VAT exclusive level. So what that means is that what? That opening inventory that is what? At VAT inclusive must be what? Must be converted to what? VAT exclusive. Then under note 3, the company they now told us that what? The company purchased plant and machinery which cost 24,750. This amount was included in opening inventory, VAT inclusive. They also purchased plant and machinery. This plant and machinery was what? Part of opening inventory. And we know that any VAT on non-current asset, is it going to form part of our input VAT? VAT on non-current asset, will it form our input VAT? VAT on non-current asset, is it part of our input VAT? No, it is not part of our input VAT. It's going to be what? Capitalized for what? Capital allowance purpose. So that means this value of 24,750 has to be eliminated from where? From this opening inventory before what? Before our adjustment. So in our computation, so in our adjustment, so we are going to say our opening inventory. We know our opening inventory, which is what? So the value of the opening inventory, so we are going to look at our opening inventory, which we are told in the question to be 24,915 million, 24,915 minus the plant and machinery figure, which is what? 24,750. Then multiply by, multiply this value. So what that means is that because it is VAT inclusive and we want to convert it to exclusive, that means what we have is what? 100% plus 7.5, which is what? 107.5. And when you say exclusive, it's supposed to be at what? 100%, which is what? The real value. So we want to make it to be 100%. That will be 100 divided by what? 107.5. So this value is going to give us what? The VAT, the what? The value of the opening inventory at what? Exclusive, which will give us what? 153,488. 153,488. Then after that, we are going to add what? Purchases. If you go to the question, we are told in the question that what? The value of purchases. Let us go to the question. We are told that our purchases figure, we have a value for purchases to be purchase of raw material 94,600. We have freight charges, it's also a direct cost, 2570, and other direct materials. All this will be added to what? To the purchases figure, including what? The opening inventory. So we have what? The purchases, which is what? 94,600. Then we have what? We also have freight charges. Freight charges. So we have that to be how much? 2750. 2570. Then after that, we have what? Other direct material. So other direct material, which is what? 13,530. So we add up all this figure together. We are going to add up these three figures together to get it. So what we now get here, we are going to less closing inventory. So the value for the closing inventory, let me go back to the question. So in the question, we are told that closing inventory, VAT inclusive is 40 million,865. We are not told that there is any information included in closing inventory. We are only told it is inclusive. We also convert it to what? VAT exclusive, because our purchases is what? VAT exclusive. So that will be what? 40. Our closing inventory will be 40 million, 40,865 times 100 divided by 107.5. So that will give us what? The value of the closing inventory, which we are going to less from this, which will give us 38,013,953. So 38,013, 38,013,953, which is what the, so when you now less this value, so that will give us, this will give us the difference between, so this value that we have, that is not the value of the VAT. So the resulting figure will give us what is called what? The cost of goods, costs, the new cost of goods sold, which is what? At VAT exclusive, which is equal to this minus this. So what we are calculating is VAT. So this value now is what we are going to apply what? Our VAT on. So which is what? This plus this. So we give us what? This value of that. Then our value now will now be what? We now get the VAT. Input VAT. Our input VAT will now be 7.5% of this value. Will now be 7.5% of 90,839,535. So that will give us the value of the input VAT. So that value, the resulting figure will give us the value of the input VAT, which we are going to less from where? From our output VAT. So that will give us a value of what? 68,12965. So which is what? The input VAT. So the resulting figure will give us what is called what? VAT payable. Give us VAT payable, which is what? So the difference between what? We have what? We have the initial one here. So we have the output VAT to be 10,642,500 minus this will give us what? VAT payable. So that will give us the value of the VAT payable, which is what? Which is equal to, so this will be this equal to this and this. So we give us that value. So this is the amount of VAT that this company is supposed to pay. But this company has already remitted certain amount. You know, say VAT, less VAT already remitted. How do we know that they are already remitted certain amounts? Let's go back to the question. In the question, we are told that the company purchased the value-added tax and withholding tax remitted during the year. Value-added tax and withholding tax remitted during the year are 217, 180, and 17. What I need is the value-added tax. Just take the figure for the value-added tax and remove it from where? From the amount of value-added tax payable. So then you now less amount already remitted, which is what? 2,173,180. So the resulting figure will now give you what is called what? Net VAT payable. So the resulting figure will give us what? The net VAT payable, which is what? Which is this value. So this is what the examiner expects you to do. So when you do this, so you'll be able to get your full mark. So that's how to calculate VAT. When we have a scenario of what? Of opening and what? And closing inventory. So you may be given a question that is going to have what? Opening and closing inventory. So when you have that, So please let us take note of that. Another scenario that we may also come across is what? A scenario whereby what the examiner will have given you the value added tax amount. Please, where the examiner tell you VAT, where the examiner has given you the value of the VAT, please, you are not applying any rate again. You are not applying any 7.5% again. Why? Because he has already given you what? That value. Please take note of that. That means where the examiner has already tell you that what the value added tax is what? Is so. He has already, he's not giving you the invoice amount. He's giving you what? The amount of the value added tax. In that case, you are not going to apply what? Any rate on it. But where he's not giving you the amount of the value added tax, so you have to apply what? The value added tax rate, which is what? 7.5 to arrive at what? At the value added tax. And you are going to use what? The invoice credit method by looking at what? The difference between what? The input VAT and what? And the output VAT. If you look at this question, we still have other information in this question. In this question, we have what? We have what? They gave us what? Other information, which is what? Operating expenses. That is what? And expenses is what? It's an indirect what? Indirect revenue expenditure. It's not, any VAT on it will be what? If you take it to P&L. We also have what? Interest and similar charges. It's also what? An indirect what? Indirect revenue expenditure. So those are what? So that is what? How to calculate what? The value added tax using what? When there is what? Opening and closing inventory. So please, any question? Any question? So I'm going to send us the Excel solution as well, so to our group at the end of the class. So any question? So in the absence of no question, so we have successfully completed. So we have successfully ended what? Value added tax. So we are going to move to our next topic today, which is what? Company income tax. So we are going to move to our next topic, which is what? Company income tax. Coming. Let me load the material. Yeah. So we are moving to company income tax. Yeah. So company income tax. Company income tax administration, which is what? Governed by what? CIT That is what? The Company Income Tax Act 2004. Cap C 21 LFN 2000 as amended. So what do we mean by this company? A company is an artificial person that is separate and different from where? From the owner. When they say a company is what? Is any entity that is separate and what? And different from where? From its owner. It has its own existence separately and is separate from where? From those set of individuals that form the company. So which means that what? A company can be what? Is liable to what? To tax, and which can be sued and can also what? Sue on his what? On his own name. As far as company is concerned, we have what? Two categories of company. We have either a Nigeria company, which is regarded as what? Resident company, and we also have what? Non-Nigeria company, which is called what? a non-resident company. In Nigeria, what would make a company to be a Nigeria company? A Nigeria company is any company that's registered with what? CAC, a company that is registered with what? The Corporate Affairs Commission, that have what? Our RC number. Such companies are regarded as what? As a Nigerian company. So why a non-Nigerian company are those companies that are what? That are not registered with what? With CAC. But they also what? They also perform operation and generate income in Nigeria. Such companies are regarded as non-Nigeria or non-resident companies. So for the Nigerian company, the totality of all their income will be liable to tax. The totality of all the profit of a Nigerian company will be liable to tax, irrespective of whether that profit is generated in Nigeria or from outside Nigeria. So that means if you are a Nigerian company, if you make an income from outside Nigeria, that income is also liable to what? Nigerian tax, but subject to what? To double taxation treaty, which is what we call double taxation agreement. Because it is possible for that income to have been subject to tax wherever you are earning it from that country where it is coming from. So any tax you pay there will be what? Will be considered as what? As a relief in Nigeria by the time what? They want to charge that income to tax. So basically, for a Nigerian company, the totality of all their income will be liable to what? Nigerian tax. While for a non-Nigeria company, it is only the income that is what? Derived in Nigeria that company will be liable to tax. So where a non-Nigerian company does not derive income in Nigeria, does not make any income in Nigeria, that's what? Non-Nigeria company or non-resident company will not be liable to any Nigerian to Nigeria to company income tax. Also, where a non-resident company, where the only income they generate are what? Are investment income in Nigeria. And basically, most investment income, they are liable to what? Withholding tax. Where the only income they generate in Nigeria are investment income. Those income will be regarded as what? As frank investment income. And this income of a company is liable to what? To tax on what? On preceding year basis. So that means what? The profit that you generate what? In 2020 will be available for tax in what? 2021. So it's available on what? On preceding year basis. And this tax is administered and collected by what? By the Federal Inland Revenue Service on behalf of what? On behalf of the federal government. So it is an income that belongs to what? To the federal government, which is collected by what? By the Federal Inland Revenue Service on behalf of the federal government. Before now, companies are usually into two forms. We have either a small company or basically company. But now, the Finance Act has what? Has categorized company into three major forms based on the level of their turnover. Categorization of company depends on what? On level of turnover. So basically now, according to the Finance Act, companies are basically categorized into three major forms. We have what? The small company, we have the medium company, and the large company. So how do we know this categorization? It depends on what? On the level of turnover generated by the company. Then where a company with a turnover of 25 million naira, annual turnover of 25 million naira and below, where the annual for 12 months, where the turnover is what? 25 million naira and below, that company is regarded as what? A small company. And the tax rate for that company is what? Is 0%. The implication of that means such company, they are what? Exempted from payment of tax. Because any company with 0% will be exempted. So that means they are not going to pay tax. Why a company with a turnover of above 25 million and less than 100 million naira per annum, annual turnover of more than 25 million naira and less than 100 million naira is categorized as a medium company with a tax rate of what? 20%. Why the third category is what? Large company with turnover of what 100 million naira and above annually with what turnover of 30%. So those are the three categorizations. Please, in the examination hall, where the examiner did not give you information about what the turnover and he asks you to calculate what the company income tax, you are going to assume what large company. In that case, you are going to use what 30%. So we need to analyze this company one after the other. We are going to start with small company. So the fact that this company is a small company, in which we said their tax rate is 0%. Small company, they are also expected to what? You must also what? They are also required to register for the purpose of tax. The fact that you are not going to pay tax does not exclude you from registration. As a small company with turnover of 25 million naira per annum and below, you must also register for tax and also what? File return as at when due. Register for tax does not mean that, okay, since you are going to register, you must pay. The reason why they ask you to register because they don't know you, so that's what they will be able to trace your record. That so truly you are what? You are a small company. You must register for tax and also what? File return as at when due. Failure to file return and register for tax is an offense which is liable to what? To penalty and interest. Then as a small company, you can also not what? You cannot deduct what? Withholding tax. You are not liable to deduct withholding tax. But there is a condition attached to it. Provided that what? That the supplier you are dealing with is having what? A valid thing. The supplier must have a valid thing and the transaction amount does not exceed 2 million naira in a calendar month. As a small company, you cannot deduct withholding tax, provided that that person you are dealing with, that your supplier, is having a valid tax identification number or payer ID. Tax identification number is utilized in the case of company, while payer ID is usually utilized in the case of what? Individual or for state internal revenue service. So where the taxpayer is having a valid TIN number or payer ID and what? The transaction with that supplier does not exceed 2 million naira. You cannot deduct withholding tax as a small company. Also, as a small company, because you cannot deduct withholding tax, you are also exempted from, your profit will be exempted from where? From payment of what? Payment of withholding tax. So, but this information is now tricky because what? As a small company, that does not mean that I'm also going to deal with what? Small company in my entire life. As a small company, I'm involved in dealing with what? Either medium or large company. And those ones, they are mandated to what? To deduct. That means if I deal with what? Either medium or large company, they are going to what? Withhold my money. So any money they withhold from me, it is expected that what? I'm going to get what? The small company will get what? A refund of any withholding tax they suffered from the relevant tax authority. So any withholding tax they suffered, so I also expected to be refunded back to them in form of what? In form of tax credit to what? Or in form of what? Cash to what? To the small company. Then small company, they are also exempted from where? Payment of tertiary education tax. There is a tax called what? Tertiary education tax. If you go to majority of these higher institutions, you see what? You see in some of the buildings, you see third fund. So that's where the money comes. It's from where? Tertiary education. So this tax is payable by what? All companies that are what? That are incorporated, all Nigeria companies, except small company. The only company that does not pay tax was small company and what? Non-resident company. So this tertiary education tax, small company are also exempted from paying tertiary education tax. Also, small company, they are also exempted from where? From claiming capital allowance during the period that they are small company. Why? Because you are a small company, you are not going to pay tax. You don't expect government to also give you what? Relief for what? For any asset that you use to what? To generate those income that you are not going to pay tax on. Then when this law came, when this categorization of came into existence. Government, they know that majority of taxpayers, they are what? They are very fraudulent and what? And wise. Taxpayer may what? May decide to devise means whereby what? They are going to what? They are going to develop a different company in order to what? To avoid what? The payment of tax. As a result of that, the tax law also what? Created what is called Anti-Abuse Act. This Anti-Abuse Act is to kick against a scenario whereby what? A taxpayer will decide to what? To go and float to various companies in order to avoid what? The payment of tax. What does this Tax Anti-Abuse Act says is that what? Any attempt by what? Any taxpayer to what? To incorporate various companies as a taxpayer. He said you want to engage in manufacture of chalk, for instance. That manufacture of chalk, you now was you incorporated company A, you also incorporate company B, you also incorporate company C. These three companies are incorporated by what? The same set of what? Directors. And this company, they are doing the same business. The reason why they incorporated these three companies is because what? They want to ensure that what? The turnover per annum does not exceed 25 million in order to what? To avoid the payment of tax. Where that is done, the tax authority, they are going to what? They are going to look at those companies and combine the company together. They are going to combine what? Those company activity together as a single entity and what? And charge them to tax. So also, when you engage in that activity, it's also an offense that is punishable. So what this Anti-Abuse Act is saying is that any attempt by what? By taxpayer to what? To incorporate what? Different companies for the same purpose in order to what? In order to avoid the payment of tax will be what? Will contravene the law, and those companies will be what? Will be regarded as what? As a single entity in which what? Their transaction will be combined together by the relevant tax authority for the purpose of what? Tax, and what? The company will also be what? Liable to what? To an offense, which will be what? Which will be punishable with what? Penalty and interest. So those are the what? So that is what the anti-abuse is liable to. So as a company, what are those that are liable to what? To tax, chargeable to CIT? A company will be chargeable to CIT in its name. You can charge a company to tax in its name. Or if the company is not in Nigeria, in the name of the principal officer, attorney, if there is an agent, maybe an agent is representing them in Nigeria, or in the name of their agent or representative in Nigeria, they will be liable to tax. A company will also be liable to tax in the name of their liquidator, or in the name of what? Of receivership or attorney. In the case of what? In the case of liquidation of company. So those are the scenario where a company will be what? Liable to tax. After small company, we now have what? Medium and large. For the medium and large company, so what are the basis of what? Of computing what? Company income tax. Either the company is medium or the company is large company. So we have what? We have four major bases of computing what? Company income tax. So the basis are what? We have a total profit basis. We have what? The minimum tax basis. We have the turnover basis, and we have what? The dividend basis. So those are the four bases of what? Of computing what? The company income tax for either what? For either the medium company or the large company. All these bases now, so we are going to look at them one after the other. At this level, you are basically expected to know what? The total profit basis and the minimum tax basis. So we have the total profit basis. So under the total profit basis, what do we mean by the total profit? So this involves what? The determination of the total or taxable profit generated by what? By the company. After what? After the adjustment of what? Of the accounting profit. Is the determination of the what? Of the total or taxable profit generated by the company after the adjustment of the accounting profit. The profit they are going to give you will be the profits prepared by the accountant. So this profit now, you need to adjust it to show to the purpose of what? Of the tax authority. So in adjusting it, so you have to do various adjustments. And in order to analyze it, you can either use what? The net profit approach or the turnover approach. Under the total profit basis, we have two approaches. We have the net profit approach. We also have the turnover approach. Under the net profit approach, when you say the net profit approach, what that means is that you are going to be giving information about the net profit. That means the examiner will give you question that we have what? Net profit. They are going to give you the value of the net profit. Please, where the examiner does not give you value of net profit, don't go and do accountant for the examiner. That means you cannot adopt the net profit approach. Anytime you have information about the net profit, you must always adopt the net profit approach. Because where you want to adopt the turnover approach, you don't have sufficient information to do that. So what does the net profit approach say? Is that you have to do the adjustment using what? Using the net profit scenario. So you look at what the net profit given to you by what? In the question, which is what? The net profit as per account. After the net profit, you add what? Disallowable expenses. You also add what? Taxable income omitted. Then you deduct non-taxable income included. We are still going to explain them one after the other. You also deduct allowable expenses omitted. When you deduct all these items, the resulting figure will give you what is called what? What is called adjusted or accessible profit or loss. You have loss if you have what? Negative. You have profit if you have what? If you have positive. This information, please, for company, the adjusted profit is also the same thing as well, the accessible profit. Please, let us take note of that. Then I now want to ask us, we did loss relief earlier. Loss relief for company. What method of loss relief is available to company? Who can remind us? What method of loss relief is available to company? We have two types of loss relief. So what are the two types? You guys are not going through your notes. So we have what? Two types of loss. We have what? The current year loss relief and the carry forward loss relief. Company is also what? Only the carry forward loss relief is available for what? For company. So if there is any loss that is being brought from previous period, we are going to consider the loss. Then we have what? The loss relief. So if there is any loss brought forward, you look at it, loss for the year. So you add the two together, the total loss. Any amount that you are going to relieve in the year. So you look at the amount to be relieved, you transfer it to this area. Then if the amount of accessible profit you have here is not up to the loss, so the difference will be what? Will be unrelieved loss carry forward. So you are going to take it to next period. Then after that, you look at what? Balancing charge. Who can tell us when do we normally have balancing charge? When do we have balancing charge? Can remind us. We also did that. When do we have balancing charge? Balancing charge.
That's when the sales proceed is more than the tax written down value.
Yes, when there is a disposal of what? Qualifying capital expenditure. And when the amount you are selling that asset is more than what? The tax written down, the value of the asset as at that time. It's an additional income, so you are going to add it, balancing charge. Then you also have a capital allowance, unrelieved capital allowance brought forward, the one for the year, then balancing allowance, then you get the total, relief for the year. The capital allowance is usually restricted to what percentage? You can remind us. Capital allowance is restricted to a certain percentage. What's the percentage? Capital allowance is restricted to a certain percentage.
66 over 3%.
Yeah. Not 1/66 to 3 to 3%. 66 to 2/3% of accessible profit. Thank you. But where the company is what? Into manufacturing and agro-allied agricultural, no restriction of capital allowance. So you also look at what 66 to 3rd. So any amount you have, you remove it from here. You also remove it from here. Then any balance will be carried to next period. The resulting figure will give you that what we call what? Total profit or taxable profit or loss. It will give you that what? Total profit or taxable profit. This total profit now is now what you are going to apply your what? Company income tax at what? The applicable rate, which can either be what? Based on what? Either the company is what? Medium or large, either what 20 or 30% of this your what? Total profit. This profit you get at this adjustment is called either total profit or taxable profit. You also calculate what is called what? Tertiary education tax. There's supposed to be tertiary in front. You have a tertiary education tax at what? S percentage, which can either be what? 2%, 2.5%, or 3%, depending on what? On the year of assessment. Which I told you that what? They are going to give you that rate at the back of your question paper in the question. So the examiner will give you that rate. So take note of that. So after getting this tax liability, we need to know what are those items, each of these items one after the other. We are going to look at what? Allowable expenses. First expenses we are going to look at allowable expenses. So what are those expenses that are allowable? Expenses that are allowable are what? The list is what? Endless. But we are just going to look at those that are what? That are peculiar, that are common. And what? And the general word that will make you to know that an expenses should be what? Allowed for tax purposes. So allowable expenses, number one, contribution to pension fund approved by what? The joint tax board. So you know that under the pension, we have a contributory pension, whereby what the employee contributes 8% of what is emolument, and the employer will contribute to what? 10%. That 10% contribution by the employer is an what? Is an allowable expenses. Any interest on loan obtained for the purpose of trade or business. It is expected that when you want to do business, it's not only, you don't use only your money. You can decide to borrow money. There is no law that says you cannot borrow money to do business. So once provided what, you see an avenue to borrow the money. So where you borrow the money for the purpose of the business, any interest you are paying on that money you borrow is what? Is an allowable expenses. Then bad debts written off, provided the following conditions are met. Any debt that has become bad and has been written off, the debt must have occurred during the what? Normal course of trade or business. The debt must have been included as part of the sales in the year of occurrence of the debt. No,
No.
deduction must have been made in respect of the debt before. All this honest. Part of the requirement of CAMA, Company and Allied Matter I, to register a company, you must have certain people that certain representative as part of your member. Must what? You must appoint what? A secretary or a legal advisor. You must also appoint what? An auditor as part of your company. So the money you pay to it is called what? It's usually called what? Legal advisory services or retainership fee. Those fees that you pay to them are what? They are allowable expenses. Then we also have what? Lease. Under lease, we have what? Short and long-term lease. Lease. For lease, only renewal of short-term lease is allowable. Only renewal of short-term lease is allowable. Any cost of protecting or defending the business is also allowable. I have mentioned rent earlier. Cost of gift to customer incorporating element of advertisement. So you are giving them gift, branded gift. When you are branding the gift, is also allowable. For any expenses to be allowable, that expenses must be what? It must be wholly. It must be wholly for the purpose of the business. It must be reasonably incurred for the purpose of the business. And it must be necessarily incurred for the purpose of the business. So for an expenses to be what? So for you to know expenses that will be what? Allowable. So those expenses must what? Must follow this criteria of what? Of rent, which is what? Wholly, reasonably, exclusively, and necessarily incurred for the purpose of the business. Then we have what? Donation to what? Another allowable expenses for company are what? Donation to what? Accredited bodies. So there are certain bodies that what? Donation are expected to be what? To be made to. So the list of those bodies are listed in what? So list of those bodies are listed in Schedule 5 of CITA. So we have what? Various bodies so that are listed. So these are the bodies for which your donation are expected to be made. So please, I will employ us to what? To look at what? Those bodies. So we have what? The various bodies for which your donation are expected to be made. But for each of these bodies, there is the one that relates to what? To our institute, which is what? ICAN. Please, the one that is what? The allowable donation that is allowed is what? Donation to made to what? ICAN building fund. Please, that word building fund must be in front of what? In front of that what? That information given to us. Where they just tell you donation to ICAN, look at it. Donation Institute of Nigerian Chartered Accountant of Nigeria Building Fund. That word building fund must be in front of it. Where they just tell you that donation to what? Institute of Chartered Accountants. So such is not what? Is not allowable. Please, let us take note of that. So it must be what? The one made to what? Institute of Chartered Accountants build. Those are the body that your donation are made to. Apart from those bodies, there are certain conditions that must be available before donation can be made. One of the conditions is that donation must be made from where? From the profits of the company. As a company, you cannot record a loss and claim that and say you are making donation. It must be, there must be what? Profit made by what? By that company. Then donation you are making must not what? It must not be more than 10% of what? Of the company's total profits. The donation you also want to make must not be more than 10% of your total profit as a company. In the case of what? In the case of donation. Then also for donation to what? To tertiary institution, research institution, and other higher institution for developmental purpose, the donation must not be more than 15% of the total profit or 25% of tax payable, whichever is higher. For donation to tertiary institution, research institution, and other higher institutions, it must not be more than what? 15% of total profit or 25% of tax payable, whichever is higher. But in the case of other donation, it must not be more than 10% of what? Of total profit. The donation must not be capital in nature, except the one you are donating to what? University or other tertiary institution or research institution. Then it must be made to what? Those bodies that we listed earlier. All these bodies that were listed earlier, it must be made to what? Any of those approved bodies before it can be approved. Then the donation must not be what? Must not be what? Don't forget it, it's not be what? Capital in nature, except in the case of what? It must not be capital in nature, except in the case of what? The one you are making to what? Tertiary institution and research institution. So those are the donation. Another form of donation that we may have is also called what? COVID-19 donation. COVID-19. Any donation made during COVID-19 is also what? An allowable donation, which is expected that it must not be more than what? 10% of what? Of accessible profit. Or it may not be COVID-19. The word they usually use pandemic or government established fund. A good example is your donation that company made during the period of COVID-19. They are also what? Allowable donation. Apart from allowable expenses, we also have what? Disallowable expenses. Please, in the exam, number one is allowable depreciation. Why? Because you are going to claim capital allowance. So depreciation of non-current asset will be disallowed because capital allowance will be claimed. Expenditure of capital nature will also be disallowed because it should be available for capital allowance claim. Any private or personal expenditure that is not for the purpose of business. Any provision, any form of provisional item, general provision for bad and when we were doing allowable, I told you when it is specific, you allow. But when you see the word general, you disallow. But please, when the examiner did not put whether general or specific, they and that to them, you assume it is general, you disallow. Any sum recovered under our insurance contract or contract of indemnity, any sum reserved out of profit, any withdrawal from capital, any contribution to unapproved pension, fine and penalty, pre-operational or preliminary expenses. When you want to incorporate a company, you are going to need the service of some professionals. Those professionals, you are going to pay them for the incorporation process. So all those professionals you pay, the total money you incur to incorporate that company is called preliminary or pre-operational or formation. That expenses is not an allowable expense. It's expected to be capitalized. Yeah? Hello, is that? It says that expenses is expected to be capitalized and available, and it's expected to be written off over a certain number of years. You are going to capitalize it as well as a fictitious asset.
Somebody is on
The
mute.
loss on, yeah? Who is on? Please, that person should mute himself. Prudence. Who is Prudence? Mute yourself. Hello, Prudence. Thank you. Then we have a loss on disposal of non-current assets because when you sell those assets, they are going to be available for capital. The purpose of your business is not to be selling your asset. So any loss you make is not an expense. Any profit you also make is not taxable. Loss on disposal of investment, legal expenses in the following regard. Yes. Cost of acquiring new lease. Please, for the lease, under the lease, we have a short or long-term lease. When you see any form of lease, acquisition of lease, whether acquisition of short or long-term lease, either acquisition of short or long-term lease is what is allowed. It is only renewal of short-term lease that is allowable. Renewal of long-term lease is also what disallowed. Cost of renewing long-term lease is also disallowed. Cost of spending a tax appeal disallowed. Stamp duty on increased share capital disallowed. Cost of defending traffic offense is also disallowed. Tax or penalty borne by a company on behalf of another person is also a disallowable expenses. Defalcation by both junior and senior staff. So that defalcation is Yoruba, they usually call it a forwarder stealing. So those people that usually they usually steal their company money. So any stealing is also not allowable, whether by junior or senior staff. Why? Because it is expected that an insurance is expected to have been established for that particular scenario. So when there is such scenario, compensation is expected to be received. Then we also have a gift and entertainment. Any form of gift to what? To employee are allowable. Then gift to customer, only branded gifts to customer that relate to what? Promotion will be allowed. Where the gift does not relate to promotion or it is not branded, it's going to be what? Disallowed. Then entertainment, any form of entertainment to staff is also allowed. During meeting, staff, some company, every Monday morning, they usually have meeting. At the end of the meeting, they do what? Item 7. After the meeting, any Cost of entertainment for staff is an allowable expense. Cost of entertainment to customer, so will be disallowed. Only what? It will be disallowed. Especially cost of entertainment to what? To anybody that is not a customer to the company, maybe friend of what? Friend of the MD. So that does not relate to the business will be what? Will be disallowed. Loan written off, any form of loan written off by the company. So any form of loan written off by the company is what? Will be disallowed. Why? Because of the nature of the business of the company is not to give loan, except where the what? Where the company is what? Is a financial institution. It is only a financial institution that what? Because their nature of business is what? Is to grant loan. Any loan given written off will be what? Allowed. But where the company is not a financial institution, any loan written off, whether to customer or to staff, will be what? Will be disallowed. Then traveling expenses. Expenses of traveling from home to office by the employee are not allowed. So when you are coming from your home to office, any expenses you incur is not allowed. But traveling expenses you incur while you are what? While you are on official assignment, those are what? Those are allowed. The advertisement, any advertisement that is capital in nature will be disallowed. Why? Any advertisement that is what? That is not capital in nature will be what? Will be allowed. So any advertisement that is what? For promotional purpose will be allowed. Then removal expenses to new business premises. Removal expenses are not allowed if the removal is due to what? Expansion scheme. So you want to remove a certain item as a result of what? Expansion or enlargement. It will also be what? Disallowed. So those, then foreign exchange laws. Under the foreign exchange law, we can have what? Realized and unrealized. Please, when you see the word foreign exchange laws, realized. So foreign exchange loss realized is an allowable expenses. The while foreign exchange loss unrealized is what? Disallowable. So foreign exchange loss realized, foreign exchange loss. So we can under the foreign exchange, we can either have loss or gain. You can either have foreign exchange loss or foreign exchange gain. So then foreign exchange loss, if it is foreign exchange loss, it can either be what? Realized or unrealized. Foreign exchange loss realized, it is what? Allowable. Foreign exchange loss unrealized, it is what? It is not, it is disallowable. Why foreign exchange gain realized is taxable and foreign exchange gains unrealized is non-taxable. Then we also have educational training. Your company is paying for your what? For your ICAN what? For your ICAN fee. It's paying for your professional fee or for your training to increase your knowledge. So where your company is doing that, any expenses they incur to carry out that is what is going to be what? An allowable expenses. But where they are spending money in order for you to acquire what? A new knowledge or skill, it is not, it's what? It's going to be disallowed. For instance, maybe you are what? You are an accountant. Instead of them to what? To pay for your ICAN fee. So they now said you should go and what? You should go and become what? A doctor. They now what? They now send you to school to go and become a doctor. So because of they are giving you what? They are paying for your youth for what? For a different skill, that will be what? That will be disallowed. Subscription to any professional recognized body, if they are paying subscription to ICAN for their member, is going to be allowed. Subscription to any recognized professional or trade association or trade union are also allowable expense. Allowable expenses. Any subscription to unrecognized trade union or trade association, they are going to be disallowed. Then we also have a taxable income. Any income that relate to what? To the business activity are what? A taxable income. Then we also have a non-taxable income. Any profit on what? On disposal of fixed asset. Profit on disposal of fixed asset is a non-taxable income. So the profit you, as I told you earlier, is a disallowable expenses. Where if it is loss, or where it is profit, it is what? It is non-taxable income. Any frank investment income, we all know what frank investment income is. Dividend is also what? A non-taxable income. Any profit on disposal of investment, because their major activity is not to sell their investment. Any reversal into income of a previously disallowable expenses. Decrease in what? General provision for what? For doubtful debt. Illegal income, bribe, any tax exempt income. Those are what? Non-taxable income. So all those are what? Non-taxable income. Then according to the Finance Act, any expenses involving related party. So any expenses that involve related party, which does not follow what? The transfer pricing requirement or regulation will be what? Will be regarded as what? As activities that does not what? That does not meet what? Meet what? The arm's length principle. In that scenario, the principle of what? Transfer pricing will be what? Will be adopted for what? For those scenarios. Then when I was mentioning allowable expenses, I made mention of what? Interest. I told you that it is not expected that you must use your money to do the business. You can decide to borrow money. Any money you borrow, I made mention that is what? Any interest you are paying on that money borrowed is what? An allowable expense. But there is what? There is a rule guiding what? Interest on what? On loan. When the interest relate to what? To when the loan is between what? Related party. That is what? A parent company is borrowing what? Their subsidiary what? Money. So where a parent company is borrowing their subsidiary money, so any interest on that money will be what? Will be restricted to what? To 30% of what? EBITDA. The interest that will be allowed, not the total amount of interest will be allowed in that year, according to section 24 of CITA. Only 30% of EBITDA will be allowed as what? As the allowable interest in that what? In that year of assessment. The balance will be taken to what? To subsequent year. For a maximum period of 5 years, the balance will be taken to subsequent year for a maximum period of 5 years on a first in, first out basis. For a maximum period of 5 years on a first in, first out basis. The excess amount. So what that means is that what? If there is any loan, if you are giving loan, and that loan, interest is between what? Interest on that loan is between what? Related party. A parent company is what? Is borrowing what? The subsidiary money. Or subsidiary is borrowing what? Their parent's money, which is what? Between related party. It is not the total interest amount that will be what? That will be allowable. Only 30% of EBITDA will be what? Will be the allowable amount. So any balance after you have calculated 30% of EBITDA will be what? Will be taken to what? Will be taken to subsequent year for a maximum period of 5 years on a what? On a first in, first out basis. And how do we? And it is not all company that is what? That is liable to this. A Nigerian subsidiary of a foreign company which is engaged in business of banking or insurance is excluded from this rule. What that means is that a Nigerian subsidiary of a foreign company that is into the business of what? Banking and insurance, this rule will not what? Will not apply to them. The reason why this rule came up is that the tax authority, they find out that what? Most of these foreign companies, they use this avenue. They use their subsidiary to what? To reduce what? They use this avenue of what? Of loan to reduce what? The amount of tax liability they are going to pay in what? In certain years. So as a result of that, government, they also what? They also bring up what? This idea of what? Of restricting what? The amount that will be what? That will be liable to what? That will be allowable, which will be what? Only restricted to 30% of EBITDA. So this particular rule can be tested by the examiner. It was tested in what? November 2021 by the examiner, which is what? The question that what we are going to look at But before we look at that question, any question so far on the note aspect? Any question? Any question? Any question? Any question? So in the absence of no question, we are going to look at this illustration to illustrate that principle of what? Of interest deductible. Well, SYZ Limited was incorporated on 31st August 2012 and it commenced business on May 21, 2013. DK Malaysia is a subsidiary in Malaysia. An extract of the financial statement of SYZ Limited for the year ended December 30 revealed the following: net profit, interest and depreciation deducted before arriving at the accessible profit of 2 million as follows: interest on the loan paid to DK Malaysia Limited, other creditors, depreciation. All these are what? Information given to us. Based on the information provided by the company, it was discovered that out of the loan paid to other creditors, 450 was in respect of loan obtained to generate tax-exempt profit. The managing director of SYZ Limited approached you as a tax consultant to explain the provision of Section 24 of CITA as amended and the 7th schedule in respect of interest deductible by a Nigerian company. Required: A. Compute the interest deductible in the relevant assessment year. B. Explain how the excess interest not deducted the relevant assessment year will be treated. Then C. Compute the total tax liability for the relevant year of assessment. If I see a question like this, assuming I'm a student, how do I know that this question relates to what? Excess interest deductible. If you look at it, they gave us, in this information, they said interest on loan. They now say DK Malaysia Limited. And they have told us that what? We have various type of interest on loan. We have the one for DK Malaysia and we have the one for other creditors. So that means what? There is what? A related party transaction between what? Between SYZ Limited and its subsidiary, which is what? DK Malaysia in Malaysia. So that tells you that what? That interest on loan should be restricted to what? To 30% of EBITDA. And what is our EBITDA? Any before interest, tax, depreciation, and amortization. Any before interest, tax, depreciation, and amortization. So this thing will be restricted to that. So in order to solve this question, so we have to look at how to restrict that. So we first of all need to calculate our EBITDA. First of all, need to calculate our EBITDA. First of all, need to calculate our EBITDA. So I'm going to use that same that SZ that I utilize for under the value added tax, so that when you are looking at your so the first thing we are asked is to compute the interest deductible in the relevant assessment year. We are giving information for 2021, and I told you tax is payable on what preceding year basis. The tax liability will be on what? In 2022 year of assessment. 2022 year of assessment. So we have what? SYZ. We have the name of the company, SYZ. SYZ Limited. Computation of interest deductible for 2022 year of assessment. First thing for us, we have to calculate our EBITDA. Calculation of EBITDA. Our EBITDA is what? Any before interest and tax depreciation and amortization. From the question, we are giving value for net profit. Net profit is profit after we have deducted all our expenses. So that means before we can get our EBITDA, we must add backward the depreciation they deducted. We must add backward the amortization. We must add backward the interest they deducted. So, and net profit is what? Profit before tax. That means tax has not been deducted. So we have what? The net profit. So I'm going to state the net profit. So I have what? The net profit. We are going to state the net profit, which is what? The net profit, which is 2 million. You now add interest. Under the interest, we have various categories of interest. We have the one for Dicky, Malaysia, which is 1,050,000, 1050. We also have the one for other creditors, which is 1 million. The addition of this will give us 2,050,000. We also add depreciation. Our depreciation given to us by the examiner happened to be 400,000. We're also going to add the 400,000. So when you add up this, the addition of the total addition of all this will give us the EBITDA, which is our EBITDA. Any before it. So it is this EBITDA now, any before interest and tax, that we are now going to calculate or 30% of it. But before we calculate the 30% of it, we first of all need to get to a total. How much is the total interest that we are even supposed to? How much is the total interest that we want to claim that this company incur in this year? So we have what? The first one, total interest that they incur happen to be 2,050,000. It happen to be these two, which is 2 million. The one for Dicky Malaysia and the one 2,050,000. Out of this total interest, we are told in this question. Let me go to the question and point out. We are told that based on the information provided, it was discovered that out of the loan paid to other creditors, 450 was in respect of loan obtained to generate tax-exempt profit. Any income that you are not going to pay tax on, they call those income tax-exempt income or non-taxable income. Because they are non-taxable income, it is expected that any expenses that you incur to generate those income should also not be what? Should also not be allowable. What the law is saying is that if I'm not going to pay tax on a particular income, that means any expenses I also incur to generate that income will also not be what? Allowable. So that means what? That expenses less tax exempt expenses, that's expenses that relate to tax exempt income, which is what? 400,000 must also be what? Must also be eliminated from this total expense, total interest. So interest now, total interest that they are supposed to remove will now be 2,050,000 minus 400,000. So which is 2,050,000 minus 400. So that is what? 1,650,000. Out of this 1,650,000 is what you are supposed to state in our accounts. But because they said we should restrict it to 30%, we are now going to calculate 30% So we are now going to calculate 30% multiplied by our EBITDA. 30% of our EBITDA. And we know 30% multiplied by, which should be 30% multiplied. Our EBITDA, as calculated above, is 4,450,000. 4,450,000. So that will give us, so the value will give us a value of so this tax exempt is 450,000. 450 is not 400, 1.6. So 30% of that EBITDA will give us a value, 30% of this value will give us 1,335,000. So this 1,335,000 now is the interest that they are going to charge in that one, in that interest to be charged. Interest to be charged in the year 2022 will be equals to what? Be equals to this value of what? 1,335,000. So which is this interest that will qualify for what? For expense. Why the excess amount? Excess. Instead of them to charge 1.6, we're only going to charge 1,335. The excess amount will be 1.6 minus 1,335 million. So that will give us, the value will give us a value of, so the excess amount will give us what? 225,000. So when you look at the difference, it will give you 265,000 naira. So which is what the excess amount of what? The value. So that information is what we have here. So if you look at your, so if you look at the solution, so that information I just analyzed is the what you have here. So the excess amount is this 265,000. So which is the excess amount. So that is what how to treat. So when there is what. So the reason why we restricted this what because what the interest is what between related parties. But if the interest is not between related parties, please we are going to charge the whole of what of this what 1.6 million. Take note of that. Then the B part now asks us another question. Says what? The B part says what? Explain how the excess interest not deducted in the relevant assessment here will be what treated. I mentioned earlier that so any excess amount will be taken to what? To subsequent year for a maximum period of 5 years on a what? First in, first out basis. So that means what? The excess amount of what? 265,000 will be what? Will be available for relief from year 2023. From year 2023, because this year of assessment is year 2022. From year 2023 to it will now be 5 years. 2023, 2024, 2025, 2026, up 2027, 5 years, up to 2027 year of assessment on a what? On a FIFO basis. You can see treatment of excess is not deducted in relevant year. The excess interest of 160 will be what carried forward and added to interest especially for the year with a view to computing the restriction. It should be noted that the excess, which is why may not be carried forward for a period not exceeding 5 years, that is up to 2027 assessment here on a first in, first out basis. So why applying what the interest deduction basis on a first in, first out basis. Then the last one, they said we'll compute the total tax liability for the relevant year of assessment. I think that this one, the solution is not here. So to compute the total tax liability now. So let us go back to our Excel. So we have the name of the company, SYZ Limited. Computation of tax liability. Computation of tax liability for 2022 year of assessment. It's very simple. in computing the tax liability. The examiner has made your work very easy by giving you some information already. You just apply those information. You have already calculated your EBITDA. Just take that EBITDA that you calculate, your EBITDA that you calculated earlier. You know, we calculated our EBITDA here to be what? 4,450,000. Just take that EBITDA calculated, which is what? EBITDA 4,450,000, which is the EBITDA calculated, 4,450,000. Then you now less the interest. That interest that you said you qualify. Less interest deductible. Out of the 1.6, we said only in this year, only 1,335,000, according to 30% of EBITDA. Only 1 million. So you now less what? 1,133,500. So it will be less from there, from that information. So the resulting figure will give you what is called what? Accessible or adjusted profit. So which is the difference between these two information, accessible or adjusted profit, which is different between these two information. So we give you accessible or adjusted. So is this information that you now apply what? CIT, company income tax, at the applicable rate. In this question, if we look at this question so let me go back to the question because I want to point out something to us. In the question, we are not told, we are not giving information about the turnover of this company. And I told you, when you are not giving information about the turnover, you assume what? What do we assume? You can remind us. When we are not giving information about the turnover of the company, we assume what?
30%.
Yeah, we assume 30%. Because the question does not give us information about the turnover, we are going to assume 30% as well as the company income tax rate. So our CIT will now be what? At what? 30% of total profit. 30%. Because we don't have loss, we don't have, when you get your accessible profit, in that format I gave us, after we got our accessible profit, when we deducted loss, when we added balancing charge, when we deducted capital allowance, the resulting figure we gave us what? Total or taxable profit after accessible profit. But if there is no all those items, your accessible profit will also be your what? Your total profit. So that means this will change to our total profit. So total CIT will now be 30% of this value of this or 3115. So 30% of this. So you are going to close this. So this will be good. So 30% of this 3115. So we give us what? 934,500. 934,500. You are also expected to calculate another tax, which is your tertiary education tax so depending on the what? On the year of assessment. So if you go to the back of your question paper, you are going to, it is either 2%, 2.5 or 3. For 2022 year of assessment, it is 2.5%. So tertiary education tax at 2.5% of accessible profit of this or 31,150, which will be what? 77,800. Should give us what? 77,875. So that is what afterward. Treating what? A situation of what? A situation of when there is what? When there is interest deductible between what? Between related parties. So please let us take note of that. So interest deductible between related party. Okay. So please, any question?